Hey, party people. Welcome to this month's investment and property market update. Guys, before I jump into the content, if you're about this sort of stuff, you can check out our other streams, Eventbrite, the Pivot Wealth website, check out my TikTok, Ben Talks Money, or the podcast, How to Be Successful with Money. And guys, please don't rush out and make any life-changing decisions off the back of what I covered today. I strongly suggest you seek out personalized advice before jumping in. If you're making big decisions, you should probably be doing that anyway. So look, it's an interesting time in markets at the moment. So I wanted to unpack some of the key trends that we're seeing. The first one is that we are seeing inflation slowing down in Australia, thankfully. So I think that's welcome news to a lot of people. Hopefully it's come off its peak. The data is all important at the moment. So we'll see what that comes through with. But the more that inflation slows, the less case there is to increase interest rates, the less pain for mortgage holders, less pain for the economy. So it's all obviously related, but seems to be, at least from the most recent data, heading in the right direction. The RBA is targeting this soft landing at the moment where they're basically trying to kill inflation without killing the economy. It's a really tricky line for them to tread, and it's hard because they've got a pretty blunt instrument in the interest rates. There's a lot of different factors that tie into this, but this is the aim for the RBA to slow down inflation, but without causing a massive spike in unemployment and a massive slowdown in economic growth. So hopefully they can get it right. They just did a big poll of the 20 leading economists in the country, and they all gave them around, I think on average, it was like a 50-50 chance of pulling this off. But they did say that if interest rates have to increase much beyond the 3% mark, that it's going to be pretty difficult to achieve. So I think everyone's hoping anyway that the rates don't go up that much, but hopefully that comes together in that way. One interesting piece of data that just came out is that new property loans were down 8.5% in August, which is the biggest decline in a couple of decades. That has some pretty serious implications for the property market, because with less people active in the property market, it means that softer prices could potentially slide further. So it's an interesting data point, and they're talking about the fact that it's the worst property selling conditions in years to be coming up over spring. So through this month and the next 2 months in Australia, the flip side of that is that if it's the worst selling times, it's the best buying times, but it does come down to making sure you've got a rock solid strategy in place. We are seeing that consumer spending is still holding strong, which is a good thing. A lot of big companies have been releasing their earnings data over the last little bit and their spending data, and looking at retail companies like Super Retail Group and Coles and Woolworths, that they're showing that people are still spending, which is good and important to keep the economy ticking along. In the US, though, we've seen the markets have been really spooked by the Fed commentary. So the US Federal Reserve, the central bank over in the US, that have come out and basically said that they're going to keep being aggressive with raising interest rates if that's what's needed to get on top of inflation. So the markets have really softened, the share market in particular, after that commentary has come out. Now, what we're seeing in the markets and the market results. So firstly, in the property markets, we've seen the Sydney property market has declined by 2.3% through last month. That's off the back of a 2.1% decline in the previous month. The Sydney property decline is leading the country, and it's now down I think 7.4% from its peak. I've actually got this on the next slide, so I'll get into that in a little bit more detail. But the Melbourne property market is down 1.2% from last month. That's off a 1.2% decline in the previous month. Brisbane down 1.8%, and that's just started turning around. Last month was the first negative month of growth that we saw in Brisbane. So that seems to be accelerating. Adelaide's and Perth have both just had their first negative months of growth off the back of a really slight uptick in the previous month of 0.2% rather in both of those states. Adelaide's down 0.1%, Perth's down 0.2%. So the combined capital cities through August down 1.6% off the back of a 1.4% decline the previous month. The regional regional property market is down 1.5% last month off the back of 0.7% decline the previous month. Looking at the decline from the peak, though, which I think is interesting, that Sydney is down 7.4% from the peak of the property market that we saw basically at the start of the year. Melbourne is down 4.6%, Brisbane down 2.6%, Adelaide down 0.1%, Perth 0.2%. Total capital cities in Australia down 4.2%, and the combined regional values are down 2.2% as well. Noting that not all areas, not all suburbs are feeling the decline in the same way. But yeah, some pretty soft numbers there. From a share market perspective, so the last month was a negative one for markets. Mainly, actually, all just came at the back end of the month off the back of that commentary that I mentioned from the US Federal Reserve. ASX is down 0.09% for the month. So pretty well flat, down now 7.4% for the year to date. The S&P 500, so the 500 largest industrials in the US, is down 3.97%, bringing the total to down 17% for the year to date. The NASDAQ was down 4.47%, now down 25% for the year to date. So obviously tech is copping it pretty hard. And crypto down 13% last month off the back of a really strong July, now down 56% for the year to date. Our investment story of the month is Zip Co. I think a lot of people have watched the sort of ups and downs of Zip Co over the last little bit. They are number 2 in Australia for buy now, pay later. And they just reported their earnings data and posted a loss of $1.1 billion, which is based on a total value of the business of $667 million. So they basically lost more than double their value. And the share price is down 78% for the year to date. Obviously, the buy now, pay later sector has been feeling a bit of pain, interest rates, what's going on with the economy. But it also shows that I think it being second in the marketplace, particularly as now banks and financial institutions are starting to enter buy now, pay later, going to be a really tricky space for Zip and any other competitors to the big end of the market there as well. In terms of market watch and things to look at for investment share markets in particular, I think inflation and rates are really crucial at the moment. Property buyers are fearful, and that's important for investment share markets because it does flow through. When people's wealth levels go down and they invest less overall, feel more fearful as well. And consumer sentiment is one of the biggest drivers of what's going on in markets. The US flow through impact is big, that even though our economy seems to be holding up pretty well in Australia, and we see that our share market has performed significantly better than how the US has fared, there is still a flow through impact, and we can't insulate ourselves completely from what's going on in the US markets. And yeah, the crypto recovery and retreat, up, down, sideways, is something that is impacting investors, and also just being a bit of a general sort of benchmark for confidence in markets as well. Looking at the Australian economic data, where there's a couple of data points to be refreshed in here, but essentially our inflation currently running at 6.1%, just waiting for the new data on that one. That's the same stat as reported last month. Household savings rate steady at 11.4%. Economic growth is at 3.3%. So the economy is still growing and growing decently, which is good to see. Our unemployment is trending down still, 3.5%. So that's a good number. And hopefully we can keep it low as we're going through this economic turbulence at the moment. Employment growth is down up 3.3%. So it's increased from last month at 2.9%. And China is really copying it from an economic growth perspective. There's been a lot of talk of their, property market issues at the moment, and the potential for stagnation over in China. But their growth rate at 0.4%, down from 4.8%, and down from about 7% pre-COVID. It does definitely have a big flow on impact through Australia. The Aussie dollar buying 69 cents, so softened a little bit from the US since last month as well. US economic data. So the inflation over there is at 6.8%, which is down from 9.1%. So it seems to have come off its peak there. Fingers crossed that continues. Their economic growth is up 1.1% from a down period in last month, 0.9%. So whether that's just turnaround is sustained or not, I suppose we'll look at the next data points to come through on that. Unemployment rate also trending down over in the US, and their household savings rate's down at 5.2% compared to 7.5% pre-COVID. And house sales are down 5% over in the US as well. Now, trends and what we're seeing in markets at the moment, we are seeing smart property buyers in particular, and been working with a couple at the moment that are taking advantage of the market conditions to really profit and come out of this period of the downturn in a stronger position than they went into it. That's something that we love to see. Crypto seems to be off the radar. All the crypto bros and broettes, or whatever the correct term is there, they seem to have gotten pretty quiet with with the market meltdown. That was something that was wildly popular up until the we started seeing a decline in November. But it seems to have people being AWOL. It probably it's probably a good thing overall. I think, like, for anyone that's been following along with our content for a while, you know that I'm pretty positive on crypto overall, and I still am. But I think where people had gone wrong with crypto is having it too much as the foundation of their investment planning, and I think that is really problematic. So now it seems to have been put to the place that it probably should have been all along, which is on the side of someone's portfolio as opposed to the key focus. We're seeing shares giving up gains and back on sale. So in July, the market rallied. It's now softened a little bit. It means that there's some more bargains out there for investors as well, picking up the shares that were good shares a month ago at a cheaper price. Fixed interest rates are quite pricey at the moment. It seems that the banks are all anticipating the interest rates to continue to increase. So we've been talking to a few people that have been looking to fix rates to get some stability over the last little bit, but notice that the rates are just incredibly expensive, which means that it's really difficult to sort of suck up that immediate guaranteed paying more for your mortgage today, as opposed to riding the variable wave when and seeing where it goes. We never really know, obviously, with that. But for me, I think that there's probably we've seen that the banks are pretty average at their forecasting, or have been in periods where the market is moving quite a lot. So if things do turn around quite quickly, locking in fixed rates now means you're guaranteed to pay more. Excuse me. And potentially, if they've got it wrong, the variable rates could flatten out sooner, and meaning that you're paying more than you need to. We're also seeing with some investors, there's a bit of fear, particularly for people that have purchased property in the very recent past that have seen their prices go down straight away. The people that bought property just over the last little bit are the ones that they probably wanted to buy a property a little bit sooner and saw the market continuing to rise. You get a bit of that FOMO, end up jumping in, and then the market starts cooling, which is never a fun time. But looking back now, people probably saying that they wish they bought 6 months or 12 months ago or 24 months ago. But I think that when you look back 6 years from now or 12 years from now, you're probably not going to be regretting it too much. So while that fear and frustration is hard to avoid, it's something that is probably not something that's going to matter too much over the longer term as well. And you don't want to let that stop you from making other decisions around your money either. In terms of the hacks and mistakes for this month, firstly, our client story of the month was individual in their 30s, income 200,000, assets and investments of 850,000. They were saving $10,000 a month when they came to see us, feeling a bit clueless around their money. For someone that was really switched on, working in a super technical profession, had fear around buying property and really lacking the confidence to invest and jump in. What they wanted was some wealth building strategies to ultimately, create that financial momentum. And what we ended up looking at for them was buying some shares and an investment property purchase, having a clear tax plan, so that they could minimize their tax and at the same time a pathway around their wealth to building their assets at a rate that they were happy with, taking advantage of the foundation that they'd set to really take things to the next level. The upside that they received as a result of implementing the decisions that they came to through the planning process was $41,000 in year one. That's after all advice fees. And over year 20, that was a $2 million upside. I want to share that because I think people don't really talk about the ins and outs of their money. So hopefully you can learn something from what other people are doing that you can apply to you. Our client problem of the month last month was these clients that we're working with a big Division 7A loan. So business owners, basically, where when you borrow money from a business, if you don't repay it within a certain amount of time, they consider it falls into what's called a Division 7A loan, which is okay in and of itself. Although over time, it does turn into a real problem because you need to actually draw money and pay tax on money to get it out so that you can repay these loans. And they had no plan as to how they were going to actually do it. What we ended up doing through the planning process is we found an opportunity to restructure their assets, to create some asset protection strategies and to facilitate a business buy-in that they were looking at doing. But at the same time, it basically solved the Division 7A loan problem and saved them hundreds of thousands of dollars of tax in the process. So ended up turning one small problem into a massive win. And that's just from the benefits of having another set of eyes looking at something that hadn't been looked at for a little while. Our money mistake of the month was someone that we're working with that had been sitting on the fence for a long time based on media fear that they'd been accumulating cash. They knew they needed to do something, but they were worried about making a mistake. So they were just sitting on the fence, gave them the confidence to pull the trigger and actually put their money to work and get it into a solid investment that was actually growing ahead of inflation, not just going backwards sitting in a bank account. So that was a really big win. Our money hack of the month was some clients, and there's actually a couple of groups, but one in particular is coming to mind that I've been working with for a little while. They've been pushing to save up a home deposit. Now, when we started working with them, they had a chunk of savings that they wanted to invest. They needed it to be much bigger to get the deposit that they wanted to get into the property market. And we spoke about the fact that when you invest into shares, you probably should be prepared to leave that money for 7 to 10 years or more in case the market goes down and stays down. They really wanted to buy a property in about 2 years from the time that we started this strategy. And we had to discuss the fact that if the share markets went down or were down towards the end of that period, that it probably wouldn't make sense for them to sell and that they should leave the money there to ride out the markets until markets recovered so that they could get their deposit out and buy their property. Now, the markets did go down, which again, never good, but instead of sort of burying their head in the sand, what they realized and what we discussed was the fact that they actually had an opportunity to invest more and accelerate how much they were investing, buying into the market while it was down, so that when the markets do recover, that they're actually getting more money out and they've got an even bigger deposit to work with so that they can have either a smaller mortgage or buy a bigger property. So I suppose every cloud's got a silver lining with that stuff, but it's a pretty common situation where you see people that are saving for a deposit. They know that they've got some time that they need to put in the work to get there. And then when markets go down, you do have an actual opportunity to do better, as much as it's never good to see your investments down in the short term. A client success story of the month had some clients that just bought their dream home following an exit from tech. Been working with this tech company for a while, managed to cash out some of their money just before the market started turning really south, got the money out and ended up buying their dream home after a bunch of years of work. Now, these clients, and it's an interesting story that when we were looking at the strategy for them, they were really believed in the company that they were working in, as we did as well. And we're considering leaving more of the money that was more of the money that they had in these shares invested because they figured that it would make them more money over time. What we discussed through the planning work, though, is that they were still retaining a decent chunk of shares. And if those shares did well, they were going to be, doing like quite rich, even richer, which is obviously a good thing. But if the shares went backwards, it was going to stop them from doing things like buying this dream home and having full financial security until they did get their eventual full exit from the tech shares. Now, since the time that we cashed out, the markets have turned pretty sour and they wouldn't be able to exit at the same level now. And in fact, it seems unlikely that they're going to be able to do that for the next sort of 12 to 24 months. So they're really pumped that they made the decision to jump in. And it sort of highlights the fact that we have this involvement bias, particularly when you've got shares in the company that you work for, that you think that they're going to do really well, but you need to really objectively look at it and go, well, what does it mean if things do well? What is the upside? What is the downside if things go wrong? And then realistically, what's most important here as well, because it can allow you to do what you want to do and do it without the same level of stress as well. So I thought it's certainly been an interesting piece to work on, but something that a lot of people can probably take a lesson from as well. Guys, that's it from me for this month. I think, definitely choppy conditions out there. Make sure when you're investing that you're smart about how you go about it. You've got a solid plan in place and you be set for profit. Cheers, team. I will catch